All right, guys. Hope you had a great weekend. Just kicking off the week right away with Alibaba, BABA. So Baba had a pretty poor week last week, fell from about 220 down to 211 on Friday. It's been down about 5 days in a row now, trading not too far from those one-year lows around the 205 area. Now, what I'm seeing here is a great buying opportunity if you're buying some time on some contracts in conjunction with low implied volatility on Alibaba. I believe the August OPEX is ripe for the picking if you're on the call side, because we have the catalyst of earnings in between now and then. It'll be toward the end of the expiration, so right before expiration. But that being said, I wanted to point out here just how much you see pops off of bottoms, right? So for instance, we saw a decline over here on September 25th down to a low of 264. Within a month, we are at a high of 319. So that gain right there was a 21% gain off the bottom. Likewise, a month later or so, we saw a decline down to a low of 252. What happened within a week? It was up to 280, right? So that right there was a gain of 11%. Fast forward another month or so, hit a low of 211, right where we are right now, roughly, right? And within 3 weeks or so, it rebounded 27.33%. So the pattern here is that on dips, you want to buy the dips, wait for about a couple of months, and sell those pops, right? Obviously, following that, we had a decline down to a low of 220.42, and then 2 weeks later, a recovery to 245 or so. That was a gain of 11%. And most recently, we had a decline down to that support area of 204.39 or so back on May the 13th, followed by a recovery up to a high of 223. That was a more modest gain of about 9.5%. Nevertheless, the average gain here is about 12%. So off the bottom right here, if we draw a line up about 12%, we get to about 240 or so, 235, 240. So I'm going to pull up the option chain right now so we can look at it. And here it is. So looking out, again, buying July OPEX is too soon because you're buying about a month of time. Remember that time decay kicks in the most drastically in the final month before expiration. So I mentioned the August OPEX, right? You have about 2 months till expiration. This also covers earnings as well, so you're paying a bit more premium. But right now you can see the implied volatility, 23.8%. The historical is 28%. Now I'm going to pull up a chart on the implied volatility just so you guys can see that charted itself and how low it actually is. Here's that chart I mentioned. 1 second. So you can see that for the past 1 year period, roughly, the implied volatility for August, July, and June are trading at lows right now. This means that you're paying the lowest premiums on options of anyone ever for this option contract, right? So for the August OPEX, the July OPEX, and the June OPEX. Now, obviously, June OPEX is this Friday, so buying only 5 days out isn't a very wise decision, given that it's binary in nature. Either you'll make a lot of money or lose a bunch of money, or it could be stay flat, for example, as well, and you might just break even, right? But the whole idea here is to catch a larger move up to 240 or 250 perhaps, and that can only be done with more certainty, again, not guaranteed, by buying more time, right? So back to the option chain again. It's right over here. 1 sec. So looking at the August OPEX, right? Now, if you go at the money, you're paying about $11 of premium. Now, right now, this denotes an expected move by August of 20 bucks in one direction. So upside 230, downside of 190 or so. Keep in mind, though, that IV will percolate as we approach the earning event in August, right? There's also a report roughly the 3rd week of August sometime. Definitive date is not yet established. Either way, I myself purchased some 220 calls for this OPEX. And the reason why is I believe that we're going to see a pop to around 240 or 250, which means that if you pay about 6 and change for these contracts, your upside is about 3 or 4 to 1, roughly, right? Now, obviously, guys, remember, do your own research, make your own decisions, right? This is all for informational purposes only. But the reason why I'm buying these so far out is because I want to catch that longer move, right? The move up to around 240, 250, maybe even higher, perhaps, if we get some kind of catalyst event via the news, which could propel it even higher than that, perhaps, right? But I do think we are near the bottom here, and the whole idea is asymmetry of risk, right? If I lose a little bit, but if I win a lot. That's the whole idea, right? You want to find good setups. Again, probability works in your favor when you find good setups. It doesn't guarantee you're going to win, but it works in your favor. This is why you look for good opportunities such as this with Alibaba. And by the way, this is the worst performing mega cap stock over the past 1 year period. I'll pull the chart up one more time just so you can see how it's performing over the past 1 year. And you'll see that it is actually flat basically year over year right now. So 1 year ago, Alibaba was trading at 213.88 low. It closed at 217.64. So 1 year from 1 year from last June 12th, which is right now, roughly, we're trading almost at the exact same price. Now look what happened within a month of that hit, right? We hit a high there of 268, right? So again, this right here was all catalyst driven, obviously via news, but that isn't to say that it can't happen again, right? So I'm saying here the setup is very, very good. Again, no guarantee, but a very, very good setup on the upside here on Bubba. And if you catch a move to 230, 240, 250, phenomenal move. The plan here is on a pop to 230 or so with a rise in IV, you sell half your position. So for example, if you bought 2 contracts for 6 and change each, you would sell 1 contract for around 13, and then you'd pull out your initial investment. That would allow you to ride your second contract up to 240, 250, 260 perhaps, and perhaps sell it for 30, 40, 50 bucks, right? Again, obviously, if you're trading more than that, you can extrapolate 10 contracts, 20 contracts, 50 contracts, depending on how much you're playing with. But remember, manage your risk. This is a 2-month position, so I would say medium risk would be okay. If you're trading smaller accounts, I'd be very cautious because again, this can go against you. And if we break down to around 205, next support area is 190 on the longer time frame. So if I pull up the longer time frame here, you can see next support would be somewhere around right over here, right? But again, asymmetry of risk here, I believe, is very, very good because as we've seen, whenever we see nice pullbacks in Alibaba, historically speaking, we see a pretty nice recovery within a month or so. The reason why I'm buying 2 months out, I don't want to endure time decay. And I also have that wildcard catalyst in terms of earnings right before expiration as well. In the event that it goes against me and I'm holding it toward earnings, I still have the catalyst of earnings perhaps to percolate IV, get out with a smaller loss, or perhaps have a random earning event where it is a surprise and it pops to the upside and I win later on, right? So that's Alibaba right there. Next discussion will be around Microsoft. So MSFT has been performing very nicely the past week or so, and I think we're going to see that all-time high touch of around 263 pretty soon. We're only about $6 off. They are just crushing it as a company right now. Very nice trend line overall right now to the upside. If I draw it from over here, you can see again right over here roughly. Right, pretty strong trend to the upside. And again, we're seeing higher highs overall, right? Higher high over here, higher high over here, higher high over here. I expect a new higher high prior to earnings. The same pattern played out last ER, right? We hit all-time highs before earnings, pull back down again, right? We consolidated in a pretty tight range for a few weeks, and then we shot up to new all-time highs. Same patterns playing out right here. Earnings were over here, fell back down, consolidated for a few weeks. Now we're pushing back toward all-time highs before the next report, right? So looking at the option chain for Microsoft, I'll pull it up right now so you guys can see. Here it is. I would, again, going a month out or less is very risky. I would go out at least 2 months. You're also capturing earnings in that time frame as well. You can see right now the implied volatility is very low, 16.5%. Historically, it's 18.5%. So very, very low right now on the IV. You're paying low premium. And looking at the option chain, high liquidity, obviously it's Microsoft, right? And so if we're capturing a longer move on the August expiration toward all-time highs, Again, premiums here are still a little bit expensive, $8 per contract or so. But you're also playing with a pretty pricey stock, right? At $257 a share, right? So looking out toward August, you might be inclined to perhaps go with the 260 contracts long. And then if you want to use a spread, again, I would leg into a spread instead of doing it all at once, because right now the IV is low. Wait for a pop in IV perhaps, or a movement toward the upside to sell premium against your position. But what you do is wait for a rise in price toward around 270, and then you sell the 280 calls against your 260s. That will reduce your debit down to around $4 or $5 per contract. Upside is about $15 or so. So you have about 3-to-1 risk reward. Alternatively, if you want to, you could sell premium against it on a shorter time horizon. Keep in mind that your break even would be 260 plus $8 or so 268. So if you were to sell premium against that on the July expiration instead, you'd sell, for example, the 270 strike for July OPEX. That would reduce your debit down from 8 down to approximately $6.70, leaving you upside of about $3.30 until the expiration, as your gains would be capped up at 270 prior to the July OPEX, right? Now, obviously, after July OPEX, if it stays below 270, those expire worthless, and then you could sell the August OPEX as IV percolates into the earning event, right? That's how I would probably play it. Selling cash secured puts right now, not a good idea because it's trading near highs. So that's out of the equation. I think that calls or call spreads are the right play going a couple months out again as well, right? And we are seeing a rotation back into tech as well, I believe, right? That's the second idea that I wanted to discuss with you guys. The third idea that I want to discuss was, again, AMD. I've been talking about it for a few weeks in a row now. But AMD has been consolidating. I'm pointing at the chart right now. One sec, sorry. Pull that up for you guys. Where did it go? Here it is. Yeah, so on the 1-year chart, again, you can see this very tight consolidation over the last 10, 11 months or so, right? Between 75 and roughly 90. And if you notice, over the past couple of weeks, or 9 sessions to be exact, we consolidated in a very tight range between roughly 82 and 80, right here, right? This type of consolidation usually precedes a move to the upside. And I believe we're going to be testing the 85-90 range in the next few weeks. Again, I like the August OPEX because it covers earnings. And right now, the implied volatility is very low as well. But I do think we're going to see a push up. And remember the saying that the longer the base, the harder the move, right? I believe this applies here absolutely. We've seen NVIDIA skyrocket the last few months. So here's NVIDIA's chart, for example. Over the last few weeks, let me just remove these trend lines right here. Over the last few weeks, NVIDIA has risen about 32%. Meanwhile, AMD is relatively flat over the past year or so, right? So I do think we're going to see a push on AMD to the upside toward 90, then 95, perhaps test all-time highs around 100, and then establish a new range there. I've been seeing that for the past couple of months. But again, this is a more patient play. Those who are patient should get paid. Again, no guarantees, obviously, guys. This is all probabilistic thinking right here, right? Now back to AMD again. So looking at AMD, we see that consolidation over here, the past 9 sessions or so. Good accumulation over here as well. I expect to push up toward around 85 and then 89, testing that post-ER high on April 28th, right? And so looking at the option chain right now, I'll pull it up for you guys as well, one sec. Here it is. Sorry, guys. Here's the option chain. So looking at AMD on the option chain, you can see that the IV is 28% roughly, historically 31%, getting about a discount of about 3% on the IV, meaning that options are cheap right now. But remember that they will percolate into the ER event, which will occur in mid-August, right? So looking at August expiration as well again, you can buy the at-the-money contracts, or they're actually a little bit in the money right now, the 80 strike for about $550, not too expensive overall. Break even will be $85.50. If you want to go in the money more, you can trade the higher delta contracts at around the 0.85. This is a safer bet, obviously, because it mimics more so the movement of the stock, given that you get 85 cents of movement in the option per $1 movement in the stock itself. So it's kind of a way of owning 85 shares at a fraction of the cost of owning the stock itself, right? And so trading I would trade perhaps the 80 strike just in case it pulls back down to 75. Again, remember, this is all probability based. It's not based upon, opinion or whatever, right? So the probability here is that we're going to see a higher move than a lower move given the consolidation. So looking at the August expiration for the 80 strikes, they're about 550 or so. And if we were to, again, wait for a rise in IV or wait for a rise in the stock price, we could sell premium against these out of the money, right? Now, if you go, for example, for a straight call spread, the mistake here is that if you start it right now and you pay roughly $3.70 of premium for this position with upside of about $6.30, it's still a very good position, right? Because you have 2-to-1 risk reward approximately. But the issue is that if it pushes to 100, for example, you're missing out on upside. So the better idea here is go long, for example, the 80 strike, wait for a rise to around 85-ish. At that point in time, IV should percolate a bit more. And then you could sell the 90 strike against the 80 strike, perhaps for a debit overall of about $2, therefore risking 2 to make about $8, right? So 4-to-1 risk reward roughly. Maximum profit would be around above 90, sorry, and break even would be around 82, right? That's a reasonable assumption by August OPEX. The question you need to ask yourself whenever you're trading options, when you're buying longer expiration dates, like August, for example, is will at some point in time between now and expiration, there be a window for me to be profitable on this trade, right? Most of the time, if trading, a week out or 2 weeks out, it's very hard to say a definitive yes. But if you're trading 2 months out, for example, you have much more ability to adjust for one. And secondly, you have a much higher probability of there being a window with which you can take a profit at some point in time. Remember that, right? Especially when IV is low, the risk is much lower because you're not fighting implied volatility as much. You're not fighting time decay as much either, theta, right? So you're buying 2 months out and change. And the whole idea here is that, perhaps you believe that AMD is going to push to around 85.90 by expiration. I'm very bullish on AMD. I think that's undervalued right now as well. And I think that $100 is going to be the norm, not too far in the future, right? So you want to be buying assets when they're cheap, not when they're expensive. AMD bottomed out a few weeks ago at around 72 and change. It's since then up about $9, but it's nowhere near where it should be, in my opinion. Again, remember, this is all my opinion, guys. Do your own research, manage your own risk, and only take risk if you can afford to lose money, because options are very risky. Remember that, okay? So that was AMD. Next up, we're going to look at, there's Home Depot as well, right? So HD. HD has pulled back nicely the past little while. And you can see over here, it's not too far from, or it's right at a support area, right at about 305-ish. But right now, it has potential to push back up to the all-time highs, around 340 or so. The option chain liquidity is not as good as AMD or Microsoft or Alibaba, but that being said, there are ways to play this if you like Home Depot. I would look at it and analyze through the lens of implied volatility once again, whereas it's very low right now. So buying options makes more sense. Again, you want to buy some more time to trade move higher. And if you're trading short-term expiration, it's more binary. I would again look at August, just because July is only about a month away, right? Otherwise, if it was 45 or so days away, I would recommend trading the July OPEX instead. But it's just too soon, wherein the time decay will kick in too soon prior to expiration, right? So you want to look out again to August, perhaps, right? And premiums are not cheap on this stock because it's a higher price stock as well. Liquidity is not as good as that of Home Depot, AMD, Microsoft, or Alibaba. But that being said, there are decent trades to be had right here, given the low IV. So a synthetic position might not be a bad idea by looking at perhaps the 300 strike, for example, which is in the money, more premium at risk, but a lower break even, at which time you'd sell out of the money contracts against it, kind of like a poor man's covered call, but for the next 2 months or so, right? So that would perhaps look like, going long, for example, 300 strike for about $18, break even 318, and at which time you would sell the short-term expirations against it at around 320 320 strike price, right? So you go long over here, for example, and then look at the July 16th expiration contract, and sell the 320, for example, for about $3, right? Now your debit will be down to $15. Break even is 315, only about $4 away from the current price, right? Pretty reasonable overall. If IV was much higher, then selling some put spreads for credits would make more sense, but it's not very high right now, so there's not a lot of premium to be had. I mean, for example, if you look at the put side, you're to sell at the support area of around 300 or so, which is a 0.26 delta. You'd sell right here for about $3, and then you'd collect a premium here of about, you'd pull in about $3, and you'd spend about $1.40 or so on the 290s. So a credit of about $1.50 will be generated on risk of $8.50 or so, right? Again, asymmetry risk is never going to be good on credit spreads, and the IV right here is not very high, so it's not really that great of a position to take a bull put spread on, right? The bullish call spread would be better overall, right? Next up, we're going to look at, we have Corsair was requested to look at this week as well. So I'm going to look at Corsair. So here's Corsair's chart, Crsr. So you can see that it's been consolidating for the past, basically since since about March 5th, right? So that's been a pretty decent period of consolidation. If you pull up the 1-year chart, looking at the weekly candles instead, you can see we've had a very tight range between 35 and 30 or so over the last roughly 3.5 months, right? Again, this typically precedes a nice movement to the upside. You rarely see a nice consolidation pattern like this, after which it falls down, right? The problem here is that options only trade on the monthly OPEX, and also the liquidity is not as great. So owning stock might be a better idea. The valuation here is very, very reasonable on Corsair. Right, just for reference, guys, Corsair is worth $2.9 billion. They're doing revenues of $1.92 billion. So price of sales right now are 1.5. And they're doing a profit right now, or generating a profit of $150 million right now, right? Growth has been very, very solid the past few years. Just for reference, 2019, revenues 1.1 billion. Last year, revenues 1.7 billion. So they grew revenues by about 60%. And this year, they're on pace for about 2 billion right now, which is pretty damn good, right? So very, very reasonable valuation overall. And you want to be buying companies when they're cheap, not when they're expensive. I would say that Corsair fits the bill over here. Just for reference as well, comparing them to Logitech, which is their competitor. Logitech, ticker symbol LOGI, they're worth $23 billion, right? So 10 times the valuation of Corsair. They're doing sales of 5.25 billion, so 2 times the valuation of Corsair, and generating a profit of $947 million. So the price of sales there on Logitech is 4.4, whereas the price of sales on Corsair is a mere 1.5, right? So this tells me that Corsair is very cheap right now. Additionally, looking at the option chain, again, ticker symbol is CRSR, right? So right now, the premiums are still pretty cheap relative to historical. So IV is 52.4%, historically 54.8%. Again, IV is higher on this ticker, so higher volatility overall. But we haven't seen that for the past few months. We've seen it sit between 30 and $35, right? Again, I mentioned that they only have monthly OPEX contracts. So I would go out a few months. This might be a better longer term play, perhaps a push up to 40 or $50 a share. I might even look at perhaps the January contracts, because if you buy the at the money or in the money contracts, you're not paying too much extrinsic premium. Like for example, if you buy the 30 strike, you're paying about $6 for January OPEX, right? Break even is 36. Current price is roughly 33, right? Just a few weeks ago, it was at $35, right? So reasonable assumption to make. And then what you could do is sell shorter term expiration contracts above your break even. So you'd sell, for example, you might buy the 30 strike for January OPEX, right? And then you might sell, for example, the 40 strike for July OPEX, right? You're not pulling in a lot of premium. You're about 50 cents. But the idea is that you're chipping away at your overall debit month by month. And when IV percolates, that's when you might catch a nice stack of premium to reduce your overall debit cost. So right now you'd be risking about $5.80 or so over the next 1 month. Break even would be $35.80. If it pushed to $40 in the next month, you might be risking about $6.50 or $7 or $8 or $9 or $10 or $11 or $12 or $13 or $14 or $15 or $16 or $17 or $18 or $19 or $20 or $21 or $22 or $23 or $24 or $25 or $26 or $27 or $28 or $29 or $30 or $31 or $32 or $33 or $34 or $35 or $36 or $37 or $38 or $39 or $40 or $41 or $42 or $43 or $44 or $45 or $46 or $47 or $48 or $49 or $50 or $51 or $52 or $53 or $54 or $55 or $56 or $57 or $58 or $59 or $60 or $61 or $62 or $63 or $64 or $65 or $66 or $67 or $68 or $69 or $70 or $71 or $72 or $73 or $74 or $75 or $76 or $77 or $78 or $79 or $80 or $81 or $82 or $83 or $84 or $85 or $86 or $87 or $88 or $89 or $90 you make a return of $4, sorry, yeah, 420 or so, or a return of about 80%, which is not too bad at all, right? That's Corsair. And then lastly, what was the last one that was requested to? There was, oh yeah, so SMG, right? Scott's Miracle Grow as well. I want to discuss that one, and then we're going to wrap up for Q&A, okay? One second, let me pull up the chart here. So this one has a pretty illiquid option chain, but the interesting find here is that it is trading right near support, right? So support right around 190 or so. Nice pullback over the last couple months of about 25%, right? And what we've seen in the past, when it pulled back in March down to a low of 185.80, what happened after that? Well, within a month or so, hit a high of 254. It's a very, very abrupt recovery, right? Right here, the asymmetry of risk is pretty good on the long side versus the short side. I think support should hold around 190 or so. The issue is that the option chain is not very liquid, so it's hard to trade with options. Obviously, you can look at longer term expiration contracts if you want, and maybe put an order in and wait for it to fill. Stock might be a better play because obviously it's more liquid in the equity versus the option chain. That being said, though, obviously it's a pricier stock, so if you can't afford it or you don't want to trade it, then obviously just look the other way, right? Just something that I noticed at support, and I think it's a pretty decent idea overall at the 190 area right now. And oh yeah, I'll also mention Intellia, right? So Intellia is also one of the Crsr stocks I've been talking about the past few months. They are pushing toward that triple top right here. Let's see if they can break above 90 or so and hit a new all-time high. A lot of positive news in that community right now between Editas, Crsr, that's CRSP, Intellia, and Beam Therapeutics, right? So those names have been running pretty nicely the past few weeks. Here's Beam. Here is CRSP. And here is Editas, right? So they've all been, rallying a little bit the past few weeks. Intellia more so than the rest, as you can see, much sharper. I do expect a little bit of a cool down, perhaps around to the 80 mark, but I do think that we're going to see all-time highs in the next month or so, right? So that means above 92 or so. Obviously, a riskier stock, less liquid option chain, harder to play because of less liquidity. But I prefer to buy the stock itself and then sell covered calls out of the money, because either you're making a nice return on a monthly basis, or you're going to own the stock at a lower cost, right? So for example, you might buy it, wait for a pullback to 80 or 75, and then sell a month out at the 90 strike call option for like $5. I mean, your cost basis would be 75 minus 5, which is 70. Upside over a month is $20, right? So 20 over 70 would be a return of 28.57%, right? So just some ideas kicking around. Obviously, guys, do your own homework. Any ideas that you have that you want to share, post them in the comments below. I appreciate that. If you think that someone else would appreciate the video, share it with them. I appreciate that too. Otherwise, have a great week, trade safe, and we'll do some Q&A right now, okay? So I'm going to turn off the recording right now.